Understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve
meeting
and serves as
live.
the bedrock of our economy.
Let's
Without
go.
price stability,
0.25.
the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing
There it is,
increases will be
25%,
appropriate
0.25.
in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris Rugaber, Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed, demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector.
All right, so you see he spoke today. Obviously, we're going to go up 0.25%. The market, let's see how the market is reacting. Not really moving right now, but it's doing pretty good. It's staying steady. We'll see what happens there. 0.25, in my opinion, is pretty good. I don't think that's the end of the world. And I think that we're headed in the right direction, right? Everybody expected this to happen. I don't think anybody was expecting anything lower than that or higher. We came in right where the market priced it at, where everybody thought it was coming in at 0.25%. Promising is my opinion on that. We're sitting at 1167 right now on Shiba Inu, and it's got a candle growing there right before our very eyes. So let's zoom in on that real quick. And as you can see, it's definitely, it's a 4-hour chart. So let's go to the 15 to see how aggressive it is. As you can see here, it's moving, pretty good sign that, the average retail seller or investors, found that to be a pretty good number. And it's showing right there. We'll see where we go from here, because our next level, if we bust through that 1175, and like I said, I don't like to look at the 15-minute chart. I really focus more on the 4-hour. I think that one's a little bit more accurate, and you don't have to look at all those ups and downs. But currently moving, guys. I mean, we're seeing it right here. This is a great video. I was able to capture the Fed meeting, and as a result, I think we're moving, guys. I think that the number was good. I think it's gonna be a slow climb. If I'm being honest, I don't think it's gonna just blow up overnight. I don't know if Shibarium is actually gonna make Shiba Inu blow up like that, but we'll see what happens. I believe that Shibarium is more for like a use case for people to build on Shibarium. It's going to bring popularity. Are we going to be able to move all our Shiba over there and get the burns up? I'm not really sure how that's going to work out. But it's looking like February 14th is our next, major news about SHIB. And I think we're gonna moon. So let me zoom out a little bit here. Give me a second. Make that smaller. Close that. And so I'm thinking that once we get past that level right there, which is the level that we can't seem to pass, and that's the let me get a little pen here. That's around right here, right there. All right, that level right there is the one I want. And I think we all want, right? Once we bust that, then, sky's the limit. Honestly, sky is the limit. Let me move that real quick, delete that. So once we pass that resistance level right there, I think I don't see why we wouldn't get to the blast through to the 15s, somewhere in that area. We all hope it happens soon. We're all ready. It's your boy Lex Millie. I'm always trying to give you the vibes. You're tuning into Crypto Vibes. I'm sorry I didn't get to introduce the video. I was just more interested in capturing the FOMC meeting, and we got what we needed. 0.25. Market's responding. It's still pretty early, and a lot of people still don't know. But I think we're gonna move up. I think it's promising, and that's all I got for you guys on this video. If you could please hit the like and subscribe button, it really helps your boy. It helps me get to the 1,000 subscribers, the 4,000 hours. I'm trying to get monetized. So anything that you guys can do for me really helps. I appreciate you stopping by the channel, and we'll see you on the next one. Peace.